So as you can see from the session outcome, there's a large range of topics that we'll potentially discuss throughout this lecture. But as you can imagine, there's various textbooks and various research papers, thousands in fact, on each individual component. So the purpose of this module and this lecture is really to kind of introduce you to the concepts, let you know they do exist, potentially explain some of the implications to real life and real practice. But as your degree goes on, you'll definitely get to understand these concepts in more detail. For instance, if we just look at the relationship between risk and reward there, you're doing that in your NX 9.4.10 module this semester as well. You're looking at the potential risk that your clients want to face and then seeing how much return you can get for that level of risk. But you're also using a portfolio to do that. So it'll be also good to have an understanding of portfolio theory. And if you want to work out when prices are cheap from an equity point of view, we'll use the likes of the capital asset pricing model to price stocks to put into that portfolio. And we also need to use the concept of is this price of the share, is it efficient? Is it priced correctly? That falls under efficient market hypothesis. So all of these concepts are theories or behind things that you'll be doing in other modules and for the rest of your degree. So to start with, we need to distinguish the difference between savings and investment, because they are two different things, but normally when you look at a bank's website, they put them together. The savings, this is more personal finance. This is the storing of your wealth, maintaining your wealth, keeping it back for the likes of a rainy day. Depending on which preferred personal finance book you look at, it might tell you or say that you should have X amount of savings relative to your lifestyle. It might say you should have at least 6 months worth of savings if your income drops. Therefore, you should have 6 months to keep you going while you maintain or try to improve your situation. So savings is really about storing wealth. Make sure you have a pot of money there for you for liquidity purposes, to get access to it if you need it. But of course, savings is closely linked to investments. Typically, savings is to buy. You might defer your consumption by saving, but you're going to use it to buy something later. So storing your wealth, but also deferring your consumption. In other words, saving for that holiday or that car, or deposit for a house. But we should treat them as mutually exclusive. You should potentially have a savings pot, and then an investment pot. And the decision you make for each should also be quite mutually exclusive. We shouldn't be investing, or we shouldn't be telling our clients to invest if they don't have any savings, if they don't have an emergency pot. And this is also the same for businesses. Businesses need to have savings for working capital reasons, liquidity reasons, and then any retained profit or anything on top of that should be invested into potentially improving their business or becoming more efficient. So what is an investment? An investment is, well, quite frankly, any vehicle that is designed to store your wealth, but then also grow your wealth. Or it could be a project where you invest in some sort of machinery, if it's a business, and then this machinery makes your business more efficient, or a production line more efficient, ultimately saving you money. So it's some sort of vehicle, whether that's tangible, you can touch it, or untangible, where you can't touch it. At the same time, you are sacrificing your finance in order to get some return. Some investments, your capital is at risk. This money that you put into this investment vehicle, whatever that product may be, you might never get that back. The investment may grow, but it may also go down. So what type of things can we invest in? Well, there's different types of investments. You have the likes of tangible and things that are not as tangible. So the non-tangible ones tend to be more financial securities. Some securities you can't really touch. It could be a trade on a screen, for instance. So securities that are not really tangible are the likes of equities, bonds, and options. Of course, they could also be tangible in the fact that if you are an owner in a company, you can get a certificate, say that you're the shareholder and all that, and that's what used to happen back in the day. But nowadays, it's a number on a screen and you have a claim to that ownership. So I say they're intangible, but technically you could get a piece of paper. But obviously the more tangible things are real estate, property, buildings, land. That's tangible. Other tangible things like golden value, gold, artwork, antiques, classical cars. You can touch them, you can hold them, but obviously you have to store them, and the storage could be an additional cost to your investment. And obviously the likes of a artwork or antique, you have to make sure it's stored safely and securely, because one discrepancy could completely wipe out the value. As part of your NX9410 module, you'll see a presentation from Rathbones, and that presentation demonstrates the historic returns on some of these alternative tangible investments. When you invest, you can invest directly or indirectly. So the direct investment is you're the owner. You purchase that one share. You buy the gold. You buy the property and you sit with it. Or you can have an indirect investment in the fact that you buy a claim to it. You put your money towards a portfolio of lots of money, and then lots of claims are added together to buy the shares, and then you have a claim on that portfolio. So typically when you buy shares, you can buy shares in individual companies on a share dealing account or through a broker, but what you're more likely to do for diversification reasons, which we touch on in this lecture, is invest in the likes of an exchange traded fund or a unit trust or a unit fund, which you cover on the last topic in week 11 of this module. So you put your money and have a claim on a part of a portfolio, which is typically managed by somebody else. And whenever we do an investment, we need to consider these three crucial factors. We need to think about the time horizon. How long are we investing for? Typically, investing is longer term. Trading, which is a misconception, trading and investment are two different things. Trading is pretty short term. You're trying to take advantage of price changes in the short term for capital gains. Investing is more longitudinal. But within this longitudinal process, you can invest for 10 years, 20 years, or even for the likes of pension, the majority of your life. So you need to factor in time. But also you need to factor in the life cycle of investing. Younger investors are going to be very different to older investors. Quite frankly, you'd expect younger investors to last longer than older investors, if you know what I mean. And as part of that, you're going to have different risk appetites, which is another factor we need to consider. Not just the risk of the product, but the risk appetite of the investor. Whenever we look at an investment, we need to make sure we understand what risk we're taking and then align that with our own risk appetite. If you're a risk-averse person, you're not going to invest in something that is very speculative and puts your capital at risk. And then lastly, we need to work out what are we actually investing for? What return do we want? And this is linked to the risk-reward trade-off you'll cover in this presentation. It's interesting when you ask someone why they want to invest in shares. They'll say, I want a high return. And you think, okay, but if you dig into a bit deeper, they're investing in the likes of shares because they want a higher return than they get on their savings, basically. Or they want to make sure that their money grows above inflation. So typically when people invest, they basically want to invest to get more money than they would in their savings account. That's obviously the personal consumer level. So then you need to work out, well, do you need to take excess risk when you could probably invest in something quite low risk, a tracker, invest more indirectly using a unit fund, which will potentially grow more than your savings for very low risk compared to buying individual shares. So these are the three factors we need to consider, not just about the individual products, but how they align with our goals. So time, return, and risk. And as mentioned in the previous slide, there's going to be many forms. We can actually buy property, machinery. Obviously on the shares side, the financial side, we can buy any financial securities. But we can arguably say that there is other very, very intangible things that we wouldn't even consider as an investment. Like you right now, watching this video, you're investing in your future, one could argue. The fact that you're doing the degree means you want to try and get a degree qualification, potentially go on to further academic qualifications, or try and get a higher tier job. So you're investing now in your education to make yourself wealthier in the future. So there is that sort of aspect as well. But to be honest, throughout your program we don't really focus on that. But ultimately your guys are doing this degree to hope you be more wealthier in the future. That's what I at least hope anyway. What types of investors are there? I mean, these examples I've already given you are really from an individual investor point of view. I'm talking about our goals, your goals. So of course individuals invest for various reasons, typically for their own retirement, potentially buy property, or to support their younger generations. But at the institutional level, we have various different types of investors. The biggest investors are actually the insurance and the pension funds, because they take, if it's insurance, they take your premium. If it's pension funds, they take your pension contribution. They pool that all up and they typically buy equity. And pension funds and insurance companies pretty much own the majority of equity that's listed on the stock exchange. And they do that because the likes of pensions are longer term. The idea is that if you invest now in the long term until you get to retirement, the idea is that equity markets will go up by X%. And because it's such a long time horizon, they can ride out any economic storm. The drops that we see in the financial crisis, the drops that we've seen during the COVID pandemic. Insurance and pension funds weren't that bothered because they know in the long term it'll go back up. Well, that's what they believe. It only really impacted the likes of pensioners who are trying to withdraw their pension at that specific time. But regulations have changed to ensure that as you get closer to retirement, the capital at risk is a lot lower, or it should be anyway. Potential other things that we need to consider is the concept of irrational behaviour. Irrational behaviour is when you make decisions when you don't fully understand what you're actually doing, you don't have all the information, and you're doing it based on emotion rather than objective fact, which is obviously very difficult. But to be a rational investor, you really need to try and match your risk appetite with the product you want to invest in and try and get as much information as possible to be well informed. But ultimately, you want to make sure that whatever you're investing in, you're doing it because it matches your risk appetite and your objectives. Okay, now let's look at a different kind of concept. In finance, how do you measure happiness? How do you measure happiness in general? How can you say you're more happier than this person? Well, in economics, we like to try and demonstrate this and put a number to it. But there's a question. How do you measure happiness? But in finance, we need to put into some sort of context. So how happy are you in the context of your overall wealth? Your wealthiness, okay, people say money buys you happiness. I'm not talking about that. But obviously your current level of wealth will impact how happy you are given a certain investment or some sort of wealth generation moving forward. So I'll give you an example of that in a second. So consider some of these examples. The first one's not financially related. But say, like me, you're a runner and you're thirsty. You've done a hard run, you need a drink, you're thirsty. Okay, so you get a glass of water or any other beverage that you prefer. You have it. You're going to start becoming quite satisfied. You're going to be a bit happier. You're satisfied, you've quenched your thirst. Your utility, your happiness, is increased. But then, say I shove another glass of your favourite beverage in front of you. You go, alright, fair enough, I'll have it again. You'll probably drink it. But your happiness won't increase much further. If I give you another one, you're probably going to get really annoyed and go, Scott, I've already had enough, come on. So, your happiness will start to plateau and potentially, you might start reversing at one point. So, if we put that in the context of wealthiness, at the start you're poor because you needed that thirst. So I give you that glass of water, your happiness shot up. But then you're in a new wealth position because you're satisfied, you've clenched your thirst, I'll give you another glass. And you're like, well, okay, thanks, cheers. Because your wealth or your happiness had already increased. It couldn't go up much more because it had already clenched you first. Gambling is very different. For instance, lottery, very low risk, extremely high reward, but the odds are very high. When I say low risk, I mean because you're really buying a lottery ticket for £2 nowadays, and you might win millions. So sacrificing £2 to win millions is most people seen as low risk. But why do you put the lottery on? Do you want to win big? Or do you just want to match 4 balls and get the 25 quid or whatever it is nowadays? If you won the likes of the lowest amount, £25, is that going to increase your happiness? Or are you really holding out for the big win to really improve your happiness? Let's plot this on a graph. So when we measure happiness or utility, in the context of wealth, we have wealth along the bottom, utility or happiness at the side. So say we have someone that's, begging on the street. If you give this person 100 quid, their utility, given their level of wealth, is going to shoot up. It's going to really spike up because they're going to be pretty delighted you give them 100 quid because their wealth is really low and £100 is a lot to them. So their utility, relative to their wealth, will spike. But say this person over here, a bit more of a privileged position. If you give them 100 quid, is their utility going to spike up? They're probably going to say, cheers, thank you for that. But really, it's not going to go by much. It might, depending on how privileged they are, they might find it an insult, I don't know. But their utility is not going to grow. If we plot this on a graph from an economic point of view, depending on whatever the scenario is, we're going to talk about gambling now. If you've got an initial level of wealth, you're given the choice of 50-50, and you take this, you can see the level of utility, whether you win or you lose. If you win, in this example, given this level of wealth, your happiness is going to go up. You're going to be proud, I just won 50 quid, 50-50, get in. But if you lose that, and you lose it, you see how much your utility drops. Your happiness drops. And for any gamblers in the room, can you remember the winners? You probably remember the losers. And that's one of the problems of gambling, is we always remember the losing ones than the winning ones. And actually, when we win, we're not as satisfied relative to how dissatisfied we are when we lose. And research has shown, in the concept of prospect theory it's called, if you'd like to look it up from a gambling point of view, there is a flip side to this diagram, and it's much steeper than the positive side. Because when we lose, or our wealth decreases, our utility or dissatisfaction drops much steeper. And this is being carried out again from the gambling industry, and the fact if we lose our utility, it drops quite significantly, as you see. But the problem with problem gamblers is if they constantly keep losing, then their unhappiness can't get any worse. So they kind of normalise it. And if you constantly keep losing, you can't get any more dissatisfied. So you just get in a constant kind of plateau state of unhappiness. And that's what's happened in the kind of cases of extreme gamblers that lose all the time. But also, think about if you lose. So the x-axis is exactly the same length. If you lose, see how much unhappy you get. The problem with some gamblers is if you lose, how do you get yourself back to before? You double up. Well, I'll just double up. Win double, put us back up to here. Well, no, that's not the case, because if you win, the increase isn't that much. So what problem gamblers do when they double up is they move the reference point, or they move the whole diagram back to here. So the axis moves all the way to this point. And they think by winning, it'll get them all the way up. But actually, when they win, it only goes up by a little, relative to the dissatisfaction when you lost. So problem gamblers do have an issue that if they do double up and try and get back to the point before the loss, then technically, if they win, their utility or wealth doesn't grow as much as it would have if they were in a profitable scenario at the start. But then if they lose this double up, they're not going to be as bothered because they've already lost. If they keep doing it, that's where we get into proper gambling habit and a sorry state of affairs. I've talked about gambling, but obviously this does happen from an investment point of view, certainly when you're on the more extreme kind of levels of risk. So if you ever read up on prospect theory and the concept of happiness and utility, quite a lot of the literature is from gambling, but of course you still apply the same references to investing. We invest at a certain level of wealth with the idea to marginally increase our utility. But we always remember the losers. And I've done my fair share of investing in the past. And yeah, I remember the losers. And I have doubled up before. I have been in that position. I could because of my level of wealth. It was pretty an irrational decision. But I did double up. I bought shares after they dropped quite significantly. Doubled my position. Because I could. And it took 5 years to get back to where I really wanted to be. But it's because I had a longer term horizon. So longer term horizon potentially made it more rational, but if I was doing it for short term reasons, very irrational. Whenever we talk about utility, we have to consider the various terms. So total utility is the overall level of happiness, the kind of shape of the graph, the overall. The marginal utility is your change in happiness. If you make a win, your happiness marginally goes up. So it's the amount of change from the event that took place is marginal utility. And diminishing marginal utility is if you constantly keep winning, your happiness first of all spikes up, but then when you constantly keep winning or your wealth increases, then the gains you're not as happy. You just get it and I won again. Cool. So the curve starts to flatten out. And of course that's on the flip side, on the losing side. So now take some time to stop the video and have a look to see which of these charts reflects the statements. Okay, so you give someone too much of something. Well, you might think, oh, it's A. But if we looked at the previous charts, that's not what the graph looks like. You don't start dropping as wealth increases. You kind of reverse and you go back down, essentially. So it's not A. That doesn't exist. So it more reflects B. You give them too much of something, so their wealth, the high wealth stage, their happiness is not going to increase. It's just going to kind of stay the same. It might slightly slope back down, but they're not going to. A doesn't really exist, so more reflects B, because that's what the shape of the graph normally looks like. This also reflects the answer to number 2. You give someone something they already have. Again, it's B. They're like, all right, cheers, got it, but thanks, all right. And 3, if you give someone something new, then that's going to reflect C. Their happiness is probably going to spike up quite a bit because it's something new. And this is all in the assumption of rational behaviour. When we talk about prospect theory, we're really talking about irrational behaviour, when you make things based on emotion rather than fact. So ideally, whenever we do a financial decision or investment, we try to make it rational. We try to make an optimal decision based on all the facts, and that whatever the decision is, it's there to maximise or meet our goals. And whenever we're rational in the sense that we've considered all possible alternatives and we prefer the certain course of action we're going to take based on knowing the range of alternatives, because the range of alternatives may not meet our goal or our expectation, but it does have an element of preference. But you can't say, oh, I'm buying that stock because I like the company. I'm not talking about that kind of preference. I'm talking about you considered the alternatives, and out of the alternatives you prefer this one. And given that you know that whatever you're going to do, it matches your risk appetite, the characteristics meet your goals and objectives, you've done the research into this individual investment, and you considered the range of alternatives, then you could argue that it is a rational decision. But it might be a rational decision that doesn't always mean it's a profitable one. And that's where we need to really not slip into the concept of prospect theory. We might have made a rational decision, but it might all of a sudden turn out to be a bad decision. It could actually destruct our wealth. You could think, I've done all my research, this meets my goal, you invest in it, and then something happens that actually made a massive loss. The decision in the first place was still rational. It just didn't turn out how you may have expected. This is where you don't want to get into a scenario where you start making irrational decisions and then you think, oh, well, I did all that, I'm not going to bother doing that again because it's a waste of time. It was still a rational decision, it just wasn't profitable. It's the problem later when you become very irrational, and then that can really hamper your utility, your happiness. When we talk about irrational behaviour, we have some Latin phrases that, forgive me, I don't want to try to read, but you have the kind of concept of being rational where you try to take into account everything, complete information, the appropriate risk. But on the flip side, you have the irrational behaviour where you don't do any of this, you're not understanding the risks, it doesn't meet your goals, and your decision may be heavily biased. And forgive me in saying this, but most personal investors nowadays, through these trading apps, they're really making irrational decisions. At the time of recording this video, in the news right now is an example of complete irrational behaviour when it comes to investing. I'm referring to the example that you might want to look of the company called GameStop, where a bunch of amateur investors, or just general members of the public, have took advice off a social media platform. This social media platform pointed out, or someone on there pointed out, that hedge funds had expected GameStop, the company, share price to drop. So someone on this platform announced this and then convinced normal people to invest in this company, pushing up the price, because if the hedge funds assume the price to drop, if you put up the price massively, then that really hampers the hedge fund, because the hedge fund thought the share price was going to go down. And what actually eventually happened was the share price in this company went up from like $30 up to $300. So every individual share, the hedge fund who'd went short was extremely exposed. So you could see this as a mini victory for all the amateur investors who are trying to compete against the hedge fund who backed against the company. But is any of this done on fact? It's really done in emotion. It's a bunch of amateur investors trying to get one over a hedge fund. Where's the rationality in that? And it also kind of links to the concept of herding, where one person says do something and then the market follows. So this information, this social media post telling people to buy, as lots of people started to buy, share prices start going up. When computers acknowledged or realised kind of market sentiment and the share price was going up, then potentially this made algorithms buy the computer, buy the trades. So it's really put up the share price. It's because someone said buy and people did. So it is the concept of herding, and then amateurs herding, and eventually computers picking up sentiment and computers herding at the same time. So quite a good example of irrational behaviour. And subsequently, at the time of the recording, the social media platform closed the account, therefore this herding or this misinformation or whatever couldn't be spread, and the share price instantly reacted in a negative fashion. Or potentially people sold out and crystallised some of the gains that they may have achieved. But of course, if you read up this, it's being investigated by the Securities Exchange in America to see if there's any sort of market manipulation involved here, which is a criminal offence. We talk about market manipulation and this sort of behaviour in financial markets institutions in this first semester of year 2. And let's finish this part by looking at the concept of risk. So we've assumed that we're making rational decisions now. We've looked at all the alternatives, but now we really need to match it against our risk appetite. And this is really what you're doing as well for your client in an X9410. We have a few concepts. We typically have 3 categories. We have the risk-loving investors, the more aggressive investors who are happy to take a high level of return for a higher level of risk, kind of more moderate, neutral investors who are really a bit indifferent. They don't really want to take too much risk, but they acknowledge it exists. And then really you have the risk-averse people who really are quite happy to take low risk and have a low return regarding that, as long as their level of wealth is maintained. And that's kind of the first thing you need to think about, certainly from a personal point of view, but if from an economic utility point of view. How do you increase someone's level of utility in various different risk appetites? But at the same time, from an economic point of view, how do we measure risk, or what is risk? Can we measure risk? What's the difference between risk and uncertainty? Well, risk is meant to be something we can measure. Uncertainty is something we really can't measure. So when we say risk, we think it is about varied outcomes, but it is measurable. But risk is not always a negative thing. You have positive risk as well. You can make gains. There is a risk you'll win. So it's not always seen as a negative thing. But when we talk about risk management, we're always looking at the downside. How do we measure it? Well, you can think, what's the best case scenario? What's the worst case scenario? That's more kind of qualitative stress testing. When we do it mathematically, we actually look at the likes of statistical tools, mainly standard deviation. We will cover standard deviation in this module, but you may have already covered it in the past, where we look at what the average return of an investment should be, and then we measure the various standard deviations from that return. The more standard deviations there are, the more unusual. The further away from the average return of an investment is the more unusual, the more standard deviations. So standard deviation is what we typically use when we mention the word risk in finance. We're working out standard deviation. When we talk about return, and that kind of goes without saying, typically when we ever invest, we're talking about two types of return. We're talking about income. So if it's a dividend, it's the coupon payment. If it's equity, it's the dividend payment. So we might invest to get an income, but at the same time we want to invest for capital gain. If it's shares, we want the share price to go up, for instance. So as an investor, you could be an investor that just invests for capital gain. You're not too bothered about income. You're not interested about dividend payments. You just want the share price to go up. Alternatively, you could be a bond investor where the bond prices don't really fluctuate that much, but you're interested in the coupon, the interest payment. And if we plot that on a graph, it looks like this. The key point here is the graph does not start at zero. There is a certain level of interest or return for nothing, which is known as the risk-free product. Typically, research and in the real world, in the UK, we use the 3-month T-bill rate, which is short-term government debt. It's seen as risk-free because it's issued by the government. The likelihood of the government defaulting over a 3-month period is extremely low because they have the ability to tax its population and all that. So a 3-month T-bill is typically a UK risk-free rate. In the States, financial institutions tend to use the 10-year bond rate in the US. So it really depends on which textbook you read, but ultimately the risk-free rate is government debt in Western economies. And then it starts sloping up, and we have, people that invest at this end, the higher risk for the higher return, are the ones that invest in the likes of shares, the likes of derivatives. It could also be bonds, but bonds from companies that have a really low credit rating. Typically, somewhere in the middle, you have moderate investors who like to have a mix of safer securities like bonds and shares. So this might be the shares from large tech organizations, companies on the FTSE 100, more safer shares. And then at the more conservative side, this might be where you invest in the likes of government debt, corporate debt of high credit rated agents, companies. So this is what your risk-reward trade-off looks like. But I think the main thing for this diagram, the rest makes sense, except from do acknowledge that there is something for free. There is a risk-free rate. And I'll finish this part on asking you a question on the measurability of this risk-reward trade-off. We've got two games here. Game A, again we're flipping a coin. If the coin is heads, you receive £5. If it's tails, you have to give me £5. Who's going to play that? What about game B? Same coin. But this time, if we flip it, if it's heads, you get 100,000. If it's tails, you give me 100,000. Which one are you more likely to play? Think about the risk-reward trade-off. And that's where we'll conclude this part. So to start with, regarding portfolio theory. Now the concept portfolio is the same whether it's a collection of artwork, an assessment portfolio, the use of PebblePad, which you might use for some of your modules next year. When it comes to finance, it's just a folder, it's a collection, a collective of items. It's just in this case, it's a case of collecting financial securities and putting them in a portfolio. And obviously, every different item might have a different size and it might have a different return. And of course, it will have different risk characteristics. But the idea is if we collate all them together, then hopefully that will minimize risk. On Bloomberg, as you'll know, you're going to use the PRTU function to create a portfolio of financial assets, and then you use the port function to view that portfolio and analyze its characteristics and performance. But when we talk about financial portfolios, there is different types. You can't just buy a portfolio of shares and you might just say, I've got a portfolio of shares. But really, what's the objective? Is it just a portfolio of shares? Or is it a collection of shares, fixed income, cash, derivatives? But let's think about the goal. What is your objective of this portfolio? Is it just for capital gain? Is it for growth? So you put your money in and the idea is it grows over time. Or do you want it to be income led, where you put your money in and hoping that periodically you get returns? If that could be the likes of dividends on equities, or if it's on bonds, it will be the coupon payments. You're not too interested in the capital growth of the portfolio, you're just about the income and you get cash flow coming in. So what's the objective? That's one thing to look at. We also want the portfolio to be what's known as efficient. You want to make sure it's in line with the risk appetite of yourself and that the products you invest in that portfolio suit that risk appetite and as a collective are within your risk tolerance. And obviously every sort of efficient portfolio will have the assumption that you have made it rationally. You haven't just collected a random bunch of stocks. You have actually kind of thought about them, you've looked at all the alternatives and you have done some rational decision making and getting an understanding of what you're purchasing in line with your risk appetite. The idea is for efficient and rational choices, if you're given a range of alternatives, you're obviously going to look for the one with the greater return for the less level of risk. Because each share or individual bond, or if it's cash or foreign exchange, they all have their different level of risk characteristics, as we acknowledged during the risk-reward trade-off. And we measure this risk using standard deviation. But as a collective, how do we do that? Well, ultimately, we can group them up together and then work out the overall standard deviation of the portfolio returns. But in order to do that, we need to understand the level of risk of each item in that portfolio. So we look at how much of that asset we have relative to the risk, and then we pool them all up in a calculation to work out overall standard deviation. When we look at portfolio returns, exactly the same process. So as I've mentioned, we look at asset number one, how much of that asset times its return. Then we look at asset number two, how much of that you have relative to its return. And obviously, depending on how many you've got, you just times the weighting by return. So you might see the portfolio formula like this and go, oh my dear, what on earth does that mean? But this symbol just means the sum of. So the total sum of your weightings of assets J times the return of assets J. The total number of each of these. And that's how you work out portfolio return. We mentioned the types of goals before. We mentioned the concept of spreading your risk. And this is what's known as diversification. You'll obviously hear the thing over and over, don't put your eggs in one basket. Because if you drop the basket, the eggs will break. This is the concept of diversification in stocks, is that you don't invest in the same asset or the same asset types or in the same sector. Because if you invest in, let's say, the supermarkets in the UK, and then there's a shock in that sector, then all of them companies are going to take the same hit. It's all going to go down together. So when we look to diversify, we can diversify across asset types. So get shares, equities, cash, derivatives, and so on. That's across different asset classes. You can potentially just invest in an equity portfolio, but within that, it can be sector focused. So you can potentially diversify buying a range of shares from supermarkets, to IT, to oil and gas, and so on. But it doesn't stop there. You could have across different countries. So you might have a supermarket portfolio, but then it might be from the UK, it might be from France, it might be Americans and Asians. So it might be kind of specific to a sector, but diversified across the world because each potential domestic location might have different characteristics. So diversification doesn't just stop at buying different shares. There's many ways of looking at it. But of course, if you diversify into different asset groups, into different sectors and different countries, there's obviously additional risks attached. For instance, different countries. If you're investing in Asia, your portfolio could take a hit when you're asleep, cuddled up with a teddy bear. You'll wake up and be a bit annoyed. If you invest in different sectors, you have to understand what the different sectors, the characteristics, how one sector might affect another sector, and all that. And certainly with assets, you obviously have to understand the basic characteristics of what's an equity, what's a bond, what's a derivative, and so on. So the more you diversify, the more information costs go up, and the harder it becomes to manage. When it comes to diversification, there is two types of risk we need to consider. And we have what's known as unsystematic risk, which is a technical term for individual risk. If you don't diversify and you buy like one share, your portfolio of that one share is heavily exposed to that one company. If that one company goes down, you're going to lose. If that company goes up, you're going to gain. So you've got unsystematic risk. You might also see the term idiosyncratic risk. Again, the risk of the individual firm. This is where you put your egg in one basket. Then you also have what's known as market risk or systematic risk. And this is something you can't diversify away because it will always persist. The market will always go up together or down together. There is more economic-wide factors that impact portfolios. When we try to diversify, another question is, what's the ideal scenario of diversification? How many equities do we need? And this is well disputed in research. And we could do this ourselves. We could make portfolios with various numbers of stocks, back test it using Bloomberg to see the level of risk. We've got an example here taken from a textbook to kind of show you the level of volatility, standard deviation, the level of risk for portfolios as you increase the number of shares in it. And it's interesting because obviously when you go from 1 to 2 then to 3, you can see there's quite a big drop in risk as you increase the portfolio size. But it gets to a point when we get around 10 and 20 to 40, certainly around 20 to 40, the level of risk doesn't drop off that much. And this is quite normal because in mathematics, any sort of normal distribution which is used to work out standard deviation, we say in maths you need to have at least 30 observations for data to be normally distributed. And that's a mathematical term. So if you get to about 30 stocks, then you can say the returns are normally distributed to work out standard deviation. So research does hover around the 30 mark. But some markets are probably more uncorrelated than others. So in some markets, it might be less shares to diversify individual risk. In some markets that are kind of highly liquid and like a wider shock impacts all the stocks, then you might need to buy more shares. So there's not one answer on what's the ultimate size to kind of get rid of most unsystematic risk, because technically it's somewhere between 10 and 40, depending on the research and the market you're in. If you want to plot this on the graph, this is where if you add more stocks along the bottom, so the number of stocks goes up, this is where the standard deviation drops. And as you see, as you can get from 1 to 2 to 3 to 4 to 5 to 10, the ideal risk of unsystematic risk drops. But then it kind of plateaus out. Then it doesn't really matter how many stocks you add, because this market risk will always persist. An example of an event that means the likes of market risk, which means every stock will go up and down. You've probably seen it during the financial crisis of 2008, 2009. And we also seen it in March 2020 with the COVID crisis, that the markets took a simultaneous hit together and all markets went down. But in normal times, the likes of an interest rate announcement, an increase in interest rates, that impacts everybody. That impacts equities, it impacts obviously more directly fixed income products and interest rate products, but it impacts a range of securities. So like any sort of economic event, interest rate setting, geopolitics, that is what market risk is. Things that influence the overall directional change of financial assets. So how does diversification actually work? How do we get to this point? Well, from research, the idea of having a diversified portfolio is looking for stocks that are uncorrelated. And what we're talking about by uncorrelated is that they don't move up and down together, or they don't, one goes up, one goes down, so they negatively correlate with one another. The idea is you'd want them to be uncorrelated, because if they're both highly correlated, in other words, they both go up together, well, they both go down together. So your portfolio is not very diversified if all the stocks go in the same direction at the same time. If it's negatively correlated and strong, it means one goes up, one goes down. If that's the case, then one will make a big gain, one will make a big loss. It'll equal zero. So that's typically what your hedge fund scenario does. So the idea is you're looking for stocks that are uncorrelated. You can't really see a pattern, or there's no real relationship or no potential for causation. As you know, correlation is a mathematical term. We will work out correlation later on in this module if you're unfamiliar with it. But correlation is between +1 and -1. +1 is highly positively correlated. In other words, two variables follow the movement of one another in the same direction. -1 is highly negatively correlated. In other words, one goes up, the other goes down at the same pace. And 0 in the middle is there's no pattern. There's no pattern between the two. And it's the uncorrelation that is better to diversify. Or if you're more hedging and you really want your portfolio to slowly grow over time, then it's more negatively correlated that you're interested. And I'll highlight that here. So if you were to have returns of, in this case, P and M, if they're both positively correlated, you can see they go up and down together. So your portfolio will do the same. If you have two stocks that are perfectly negatively correlated, like N and M, then you can see this one goes up, that one goes down, and quite frankly, your portfolio stays a straight line in the middle. So this portfolio waves in the middle, this one, straight line. So to reduce your overall risk of spotting patterns like this, the best is to kind of combine some either low negative correlated stocks. Because if they're uncorrelated, you don't have this kind of patternless. And what we can see that from the diagram is if you have things that are the likes of negatively correlated or low correlated, you might have F doing that, you might have G doing that. If you combine them, you can see the bend in the curve is not as steep. So it really brings down the volatility of the returns. Here I've provided a real world example. So what I've got here is I've done the correlation matrix for a range of different benchmarks. Now the first thing to point out is because these are benchmarks, so the FTSE 100 and the S&P 500, technically they're very diverse portfolios anyway, because the FTSE's got 100 companies in, the S&P 500 has got 500 companies in, so them benchmarks are very diverse as it is. But what I've done is I've kind of got the data for the benchmarks, and I've got the likes of the 10-year bond rate in the UK, I've got the FTSE Bank, so the banking sector in the FTSE, the telecoms and leisure, the FTSE for Good and Ethical Fund, and I've got the European corporate debt benchmark. And I've just run the correlation calculation between the returns for a year, and then you can see the likes of which are more positively correlated and what are negatively correlated with one another. So take a moment to stop the lecture recording here and think, if you want to diversify your portfolio by buying a few of these, which ones are you actually going to buy? So as we noted before, you're going to potentially buy the more uncorrelated or slightly negatively correlated stocks. So if we have a FTSE 100 stock, so we're invested in an ETF for the FTSE 100, then you're probably going to diversify by also buying into the UK Treasury 10-year bond, and also buy potentially additional stocks in the FTSE banks. But you're not going to buy corporate debt or the ethical fund, because they go up in line with the FTSE 100. So anywhere where you see it's red and slightly small, then you're probably going to invest. The pair that is the least correlated amongst the lot is the FTSE Travel and Leisure and the UK 10-year bond index. So that is the least correlated because it's the smallest number, but it's also negative, which helps for diversification further. And all of this really comes from Markovich's portfolio theory. And Markovich's portfolio theory does base a lot of the concepts regarding correlation in portfolio management. And as well as correlation, we always look at the likes of regression. So in any statistical technique, when you find a relationship between two variables, which could be two stock returns, first of all you look at the relationship, correlation, then you move on to say, does one explain the other, regression. If you remember that formula from your stats days, y equals mx plus c, that's the line of best fit. So if you had to plot returns of x against plot of returns from y, if you put all them dots together, then try and find the line of best fit, you get y equals mx plus c. Well, that m in finance is what's known as beta, volatility, comparing return of one against the return of another. When we plot the line, the slope of that line is what's known as the beta of the stock, which is a measure of volatility. And we use this beta in the capital asset pricing model. If you want to do lots of research on CAPM, do take your time. There's a lot out there. It is a formula. It has about 6 or 7 or 8 assumptions behind it. So it is a capital asset pricing model. In other words, it's a way of pricing shares. But within that, there's a range of variables you need to understand, and one of the key ones is beta. And whenever we work out this term beta, it's the slope of the line. If you go to Bloomberg and type in beta, you will get an example of a slope of a line. You have to have a company selected, and then it will compare that company's returns relative to the benchmark that company's on. It will plot the daily returns of the share versus its benchmark, and then plot the line of best fit, which gives you the line, and then you can work out the slope of the line, the beta. And if you have a slope of 1, that simply means your stock moves at the same rate as the market. If you have a beta of 2, then that's a more volatile stock. The stock moves in price twice as much as the market. If it's negative 2, again it moves twice as much as the market, but in the opposite direction. So when we're thinking of diversification, again, what do we want? If we go for a volatility or beta of 0, then that's just going to follow the market. So it'll be subject to a lot of market risk there. And then if it is 0, well, then we're just going to get market returns because it moves up in line with the market. So if you wanted excess returns than the market, then you might want the likes of a more positive beta, which goes up twice as much as the market. If you have a look at the interpretation on the slide here, if you've got a beta of 0.15, if the market goes up by 10, your share should technically go up by 15%. Obviously you can work out beta yourself, but if you go to any sort of website, it will tell you the stock's beta. The only problem with beta is it depends on what data you use. Because calculating beta, I said you're comparing the returns of the stock versus the returns of the market it's on. If you go to Bloomberg on the terminals, it always uses 2-year data weekly. So it'll have 104 different dots and then the line of best fit on them dots. But you can change that. You could have 1 year daily, so you get 250 dots. Obviously there's 360 days in a year, but on average it's about 250 trading days. And then it'll plot the line of best fit amongst the 250 dots. So obviously beta itself can be manipulated depending on which historical data you use. And if the likes of your stock and your market are very uncorrelated, in other words the dots look like shotgun shells going off and there's just dots everywhere, then it's quite difficult to plot a line of best fit. And then that actually makes beta unreliable. So just to summarize there, when we have betas, we can also look at this from a risk tolerance point of view. If you're looking for something that doesn't move as much and is more defensive, then you're going to look for betas less than 1. So they don't move as much as the market does. So you might look at things that do kind of mirror the economic cycle, more secular stocks. But then if you want to be more aggressive and take on more individual risk, more systematic risk, then you're going to look for the more aggressive stocks, the ones with greater betas. So you can look at beta, because it's a measure of volatility, you can look at this from a risk point of view. Whenever we get into more detail about calculating the likes of beta in the capital asset pricing model, then we can see how we calculate it mathematically. Because it is about comparing something, a stock, against the likes of its market, we're looking for what's known as the covariance of the asset within the market portfolio, divided by the overall variance of the market portfolio. Now, if you're unfamiliar with the terms that I've mentioned, the likes of variance, well, if we look at the formula here, this sigma, that's standard deviation. Standard deviation, that's risk, the more unusual that we mentioned before. Variance is just standard deviation squared. But ultimately, when we talk about calculating the likes of beta, we will go through this in extreme detail as we grow throughout your program. And certainly when we get to the final year and we're doing portfolio management, we'll certainly be using this sort of mathematics. You will cover this mathematics in detail in semester 1 of second year when we talk about financial stats and statistics. So we will go through these concepts and the mathematics in more detail. But for this module, it's just the understanding that beta exists. It's a measure of volatility of comparing a share against its market, and that it's calculated using the return data for each. We will plot that return data on the line of best fit, and that's the slope of the line, is beta. So here is another example where I'd like you to stop the recording and have a look and try and answer the questions that are on the screen. So question 1, over the year, which share is the most volatile? Well, if we look at the 1 year beta, then that's Aberdeen Asset Management. If we say which share is the most volatile in the last month, then that's actually Tesco's. If you're the more conservative investor, risk averse, remember, which one are you likely to pick? Well, over the year, you're more likely to go for the likes of Randgold, which is a mining company that mines in gold. Obviously, if you look up the research and the historic price of gold, you might understand why that's quite a defensive stock. Its major commodity is gold. But you also might go for the likes of G4S because that just follows the market typically. Question 4. Which stocks would a FTSE 100 tracker hedge fund pick? Well, actually, if I think, I'll go for the stocks that are like closest to 1, like Randgold, well, technically it's a red herring question. If they're a FTSE tracker, they'll invest in all of them because all of them are on the FTSE. And then another question is, people always ask me, what's the beta of the market? Well, it shouldn't really be a question. because beta is a measure of volatility against the market. If you plot the FTSE 100 returns against the FTSE 100 returns, you're going to get a straight line. You're going to get a slope of 1. So the beta of the market, it's 1. It's not really a question. And then we finish by looking at expected return. Well, this is actually the capital asset pricing model. So depending on what textbook you read, it might call it CAPM, it might call it expected return, it might call it required rate of return. It's essentially a calculation of expected return for a stock. So within the formula, you have risk-free. Remember from the risk-reward trade-off, the risk-free is government debt. You have beta, the volatility against the market, times by the market return minus risk-free. So that's the formula written out. You might see it in different forms, there might be different acronyms here, but ultimately is risk-free plus stock volatility times by the market return minus the risk-free rate. So we've just got an example at the bottom. You've got a company, a stock of beta of 1.31, in other words, slightly more aggressive than the market rate, market return. You've got that's beta here. We can clearly see the risk-free rate is 6%, market return being 11%, then the required rate of return is 12.55. And that makes sense because it's slightly more aggressive than the market. The market return is 11%, but this isn't actually that much higher than the market because risk-free, the thing you get for nothing, is also quite high. So it should be greater than 11 because beta is greater than 1. But it really depends on what the risk-free rate is, depending on how high your expected return for this share will be. So do read up on the capital asset pricing model. And whenever you look at the likes of Markovich's portfolio theory, it will say this is an equilibrium theory based on portfolio theory selection. And it does have a practical tool of helping investors work out the required rate of return of a stock before investing in it. Because if they work out the required rate of return and the actual return is much lower, then you're not going to invest in that stock. If it doesn't meet your risk appetite, you're not going to invest in the stock. So it's just another tool of working out how much do I need to return on a share before I invest. But remember, there's going to be lots of various assumptions in that formula. Assume what risk-free is, assume the market rate. We're going to use beta, but we know we can change beta by changing the calculation, and so on. So there's lots of assumptions in them formulas. And they're going to be explored in a lot more detail as you go out through this degree. So it's a good point now to start understanding what the capital asset pricing model is, the concept of beta, and so on. For this module, it's just a case of knowing they exist and interpreting or remembering the formula. But in future, you'll have to potentially use them in assessments and then demonstrate your understanding by critiquing their assumptions and the output. And to finish this lecture, there's a few quiz questions there for you to answer that we'll pick up in the seminar. And I hope from this you kind of understand the range of different theoretical concepts that we're going to cover throughout the rest of your degree. But for your exam revision, it's just a case of remembering that what these are and what they try to represent, and what is the likes of the portfolio return formula, what's the formula for that capital asset pricing model, what does beta mean, and how to interpret it. And that's kind of the level we want to know for the examination of this module. And thank you very much for listening to this week's lectures.